A very good evening and a warm welcome to Personal Finance. I am Kukuletu Cele. In today's show, we examine investing and savings products so that we can better understand which of these need to form a part of your portfolio. Joining me now in our Johannesburg studios is Peter Hewett. He's a certified financial planner as well as a 2014 FPI Financial Planner of the Year winner. Also joined by Stephen Schultz, who's of the Investment and Savings Center of Excellence at MMI Holdings Limited. Well, we will get an overview of the Pan-African approach to financial planning as well as savings and investment products. But let's start off with the Sub-Saharan African focus and maybe South Africa too. Peter and Stephen, thanks for joining us this evening.
Thank you.
If we paint a picture of the savings rate, I think so often we hear the quotes that South Africans save only so much of GDP. As a result, the nation itself has to rely a lot on international borrowings. But in simple terms, for the man on the street, what does this mean?
Look, I think the bottom line, Gugu, is that we as South Africans definitely do undersave. As far as retirement is concerned, we does save. In fact, even at government level, we does save at the moment. So I think it is a challenge, but I think it's a challenge that is quite prevalent in a lot of developing countries as well. So I don't think we need to necessarily overstate the fact, but I think it is a challenge and something that we need to address. And the way I see us addressing it are through shows like this, where we inform our listeners or viewers, where we inform the public on what is available out there to utilize as savings vehicles, what are the best methods to use to save for your future, and how you can access these various products regardless of where you live in Africa, to make sure that we encourage people to actually start saving. Many people just have a fear of the different types of products. So. Yeah.
Would you agree then, Stephen?
Absolutely,
Is there that
absolutely.
concern?
I think education plays a big role in savings. So obviously you can address it on many levels. So you can save at a particular need level. Maybe bring it home for consumers by talking about a specific need that they plan on servicing. Something like retirement would stand out as a good example. And then you can talk about it holistically as an economy, what that means for a country, and why it's so desperately needed for South Africa in the same token to increase the savings rate.
Let's talk about it from the consumer's perspective, and we'll get into retirement in a moment because that's always the contentious issue. But the one thing that CFPs always tell us is that you need to discern between your goals, short-term, medium-term, long-term, and I take it that's where the trick comes in. Let's start with the short-term goals. Are there sufficient products in the market, and are they being used appropriately by consumers? Peter?
Look, Gugu, I think so. I would agree fully that structuring your asset base from a savings perspective between short, medium and long term is absolutely critical. I think that there are suitable products in each of those buckets that are made available by the financial markets.
Feel free to give us some examples, especially from a South African context.
Yeah, look, in the short-term space, obviously you have various call accounts, you have money market accounts that give you exposure to slightly longer-term instruments, comparative to your normal sort of bank savings account, so you can get some form of yield enhancement or improved return even in the short-term space by looking at the different types of products that are available and the term structure of those products. I think the one challenge that we do have is, as I said earlier, accessibility to information regarding the various products, and I don't think that's just necessarily a South African thing. I think across Africa it's a bit of a challenge. But the products are available. It's really about consumer education and delivering a value proposition to a market by financial service providers.
And I take it, like you say, there's a uniqueness to all these different geographies because we know some banks have tried to introduce savings accounts in other markets across the continent. And we can't forget mobile technology as well, where there's some kind of savings pockets attached there as well. So that's obviously something consumers need to look into as well. What works for them, in other words, Stephen?
Agreed. And I think, just to echo the point, I think there is an adequate toolkit in terms of products and asset classes which are available to invest in for consumers. I think the real trick is the way you blend some of those asset classes into products and shift the conversation a little bit from a generic nature to one that is able to meet a client-specific need and to deliver on a specific outcome that might mean something to an individual. I think really that's the trick that we need to maybe apply our minds to and get closer to.
Having said that, though, what do you make of tax-free savings accounts that have been introduced in South Africa? Is that a perfect fit for everyone or maybe catered to a particular group?
Yeah, look, I think they're a great product. I would encourage more products of this nature. I think they definitely meet a need, which is, as I mentioned, I think the trick in the whole scenario. Whether they meet every single person's need, possibly not. To some people, absolutely. To some, possibly only to a degree. Whilst they're a great product, they do come unfortunately with limitations in terms of contributions. So I think it's 30,000 Rand a year, or otherwise R500,000 per lifetime. And to some of your high net worth individuals, that might fall short of an all-encompassing solution. Yeah.
Peter, I take it you agree, because you have to fit all of this in together, short-term, long-term, finding the appropriate products and exposure to the relevant markets, right?
Yeah, I think maybe just a point on the tax-free savings products. They are very good products, and I would really encourage any government to look to those types of alternatives to make them available to members of the public to encourage saving. The one challenge that you do have, though, for example, locally with our tax-free savings product, is that you can currently invest around 400,000 Rand. After the interest rebate, you're still paying no tax anyway. So really, the tax-free savings product is catering to those individuals that have more than 400,000 Rand in cash available from a tax savings perspective. You know, so has it addressed the correct need? You know, these are, I think, some of the questions that we need to ask. You know, is it catering to the right markets? I think, you know, there's quite a big gap in this country in terms of, you know, our Gini coefficient, or, you know, the wealth levels in the country. And I think what we need to do is possibly look at products that are more suitable to the lower end of the market to encourage savings at that level, because obviously that, from an education point of view over time, would have a far bigger impact. Looking at your short, medium and long-term structures, though, the one thing that I think is critical, and you know, this is where Stephen will come in, the asset allocation of your underlying structure is absolutely critical. And the reason that we do split between short, medium and long-term is very simply your short-term funds should really be there as an emergency fund. That's the only reason you keep short-term monies, so that you don't need to access longer-term money that's invested somewhere during times when market conditions aren't appropriate to access that money. Your medium-term funds, your intention would be to have a slightly less volatile or less fluctuating investment, an investment that's less exposed to market conditions, but still that does give you exposure to various types of market returns. And then your longer term funds are those funds that you would go into very equity based type investments, where you're looking at achieving very long term sustained returns, but where you're prepared to accept quite high levels of volatility. And the mix between that short, medium and long term is very dependent on your own personal circumstances and needs. So you can't bucket people into, you need X, Y and Z in terms of your structure, which is, I think, was the point that Stephen was making earlier.
So I can't have a conversation with my friend at the bar and say, oh, that works for you, maybe it will work for me too.
No,
not at all.
Yeah.
Not at all. I think it's a great point. You know, there's no secret formula or silver bullet. I think each person's individual needs need to be assessed, and the trick is blending it in a meaningful way. So as Peter said, you know, it's very important to get real returns, so after inflation returns.
Yeah.
Some of the
and maybe if you can explain that concept for us as well, because sometimes as consumers and investors, we hear all these terms, but we don't really understand and grasp how they impact our finances.
So the best example is cash. So you can walk into your bank, you can get a pretty decent interest rate if you shop around, I'm sure. And that's on a nominal basis, or what they print, what's in the shop window. But the truth is that's not really what's important to investors. What's actually important is what they get from a real basis after inflation, because every year things get more expensive. So growing your money as an absolute doesn't really make a lot of sense. You need to start growing wealth in real terms. And unfortunately, I suppose the only way of doing it is to venture along the risk curve and to accept a little bit more risk, which is exactly the point. Now, the balancing act between taking risk is a very sensitive one, because if you need to be withdrawing your money within 3 months or 6 months, etc., you need that safety of knowing that your money is going to be there at the exact same money, which is where cash accounts come in. But the truth is, I suppose a young individual is the best example, someone who's trying to build wealth. It doesn't make a lot of sense doing that purely in money market or fixed income type instruments. You need to take a little bit of risk, which is where the discomfort factor comes in. And maybe through education that can be eliminated.
I'm happy you touched on age as well, because sometimes that does play an influence as well when it does come to the asset allocation question.
Absolutely.
But obviously, is it just the generic argument that if you're a lot younger, in your 20s and 30s, that you're able to take on a lot more risk than counterparts were slightly older?
Look, I think as a rule of the thumb, it's probably a good guideline, but not necessarily all-encompassing. There's various other factors that need to be taken into account. Things like your reliance on your income, the level of your income, the level of your network and what you look to do with wealth. for example, some very high net worth individuals that are very young might not need to take on a lot of risk because they're not really in the wealth generation phase, they're more focused on preservation.
Well, we'll continue with our conversation. For now, though, we're going to take a quick ad break, but my guest, Peter Hewett, Stephen Schultz, will still be with us, and we'll get the East African perspective on savings. That's with Patricia Kiwanuku, who is from Old Mutual. We'll continue taking a look at investing and savings products here on the show. Don't go anywhere. Welcome back to Personal Finance. Well, we continue our look at investing as well as savings products which are being offered across the continent with my guest, Peter Hewett, a CFP professional and the 2014 FPI Financial Planner of the Year, Stephen Schultz of the Investment and Savings Centre of Excellence at MMI Holdings Limited, and in our Nairobi Bureau, as promised, Patricia Kiwanuka, MD of Asset Management at UAP Old Mutual Group, now joins us to give us a view from the East African perspective. Patricia, let's pick up with you. Just before the break, we touched on several themes, being the nature and culture of savings, in particular in the sub-Saharan context of things, but also the kind of products that might be popular that the financial services industry is offering to the market. When it comes to Kenya, what are the statistics and what's the environment like? And are consumers responding positively to savings?
Thank you. I think it's safe to say the consumer in Kenya is interested in getting savings across and trying to figure out how to start accumulating their wealth. The challenge clearly being in this part of the market is finding the balance between how much you want to put aside to save and how much you need to use for consumption purposes. So the products are in the market that encourage savings. I mean, starting from as low as Kenya shillings 10 on the mobile app to higher, more advanced products. But it's really not picked up. The culture for saving is really not picked up as aggressively as we would like in the market.
Just to stay with you for a moment, Patricia, where are we falling short? Is it the product offering? Is it a lack of education? And one would automatically think that maybe mobile technology is also trying to boost the level of savings in Kenya?
I don't think it's, well, education is one part of it, especially when you look at the mass or the foundation type market people. But you can't quite say they're not educated, because these people run businesses. It could be a small business, but they run it. And they're able to take their children to school and do what's necessary to make their everyday living happen. I would say it's more a case around, have we found the right distribution to tap into that space of the market without increasing our costs significantly. So the mobile technology provides that platform. Unfortunately, I think from a product perspective, may not have been designed or has been used more for consumption than for saving purposes. So I think as the culture and the need to emphasize that people need to save takes root, that will be a good change for our market.
A big topic when it comes to savings always has to be retirement, and we touched on that, hey, Stephen, in the first half of the conversation. Sure. And the big question is always, how much is enough? Because I sit with my colleagues and we always talk about, 15%, and everyone comes back and says, actually, when I take a look at all my expenses and the living costs that I have to bear month on a month basis, 15% is actually a bit too much for me to part with for retirement savings.
Yeah, look, I think it's and this is directly in Peter's area of interest, but I think it's very difficult to come across once again with a uniform rule. It all depends on investment returns, time periods. Obviously, the younger you get started in saving for retirement, the better. So it's always difficult. There are a number of rules of the thumb, though, that we often employ. I mean, there's once again, it's not an exact science, and I wouldn't focus too much on them. But I think the general consensus is one should look to replace their income in retirement phase with about 70% of what they've become accustomed to while they were working, which, as a rough rule, is a difficult, it's a tall order.
One of the ways, because no one wants to cut back on those living costs, right?
And one of the ways in which mathematically could perhaps work without being overly generous on investment returns would be accumulating approximately 15 times your annual income. So just to put that in practical terms, somebody, let's say, for example, earns R1 million a year, would look to replace that in retirement with 750,000 Rand a year income, retirement income. and would require approximately 15 million rand as an asset base in order to retire. Now those are obviously big numbers, which is exactly why we have such a problem in this country in terms of retirement savings, where only 6% of South Africans can actually afford to retire. And that number is pretty consistent through Africa, in fact sometimes less than 6%.
Exactly. Does that maybe take us back, and maybe you would be able to give us more clarity here, to the right exposure to the right products? Because I take it with retirement savings, the earlier you start, the better, as well as the power of compound interest are the two things that will actually work to aid that wealth creation, rather. Peter, Stephen?
Agreed.
Look, absolutely. I think the power of compounding is absolutely critical, and I agree with Stephen's point. I don't think you can sort of brush the entire industry, with the same sort of brush. Savings for retirement, I think, really need to start with what is your need at retirement. Different people have different needs. They have different family circumstances. I would agree that there are certain benchmarks, 70 to 75% of your income, but that would, for example, differ dependent on whether you were married with any dependents or not, or whether you intended traveling after retiring, etc., etc. So there are quite a few factors that impact on what you really do need to have available. And the best way to calculate what is required is to start with a need. And it's can be a reasonably complex process, but it can be simplified by a good financial planner. You need to start with what is your likely need on retirement in today's terms, calculate what is a realistic need, and then work everything out backward to get to a point of what do you need to put away today to make sure that you achieve that goal. And if it is restrictive, so you're not able to actually save that amount, start with an amount, understand what your shortfall is going to be, plan accordingly, and over time try to adjust that so that you still ultimately achieve your goal. And the other thing, of course, that's absolutely critical is the return side, and Stephen mentioned it. Having a need of a certain capital amount is one thing, but if your return during the entire savings term is 2%, you're going to have a very different savings requirement than somebody who achieved a return of 20% would have, as an example. I mean, I'm using extreme examples, but to illustrate the point, it would be massively different savings requirements.
Exactly.
Yeah.
And then one additional caveat, if I may, and I think that's also it's quite responsible working backwards. But I think often what happens is people underestimate how long they're going to survive for, and that's a trend that we're seeing at the moment. I'm not sure whether anyone saw recently, but we had an article feature in the Time magazine which suggested the next person to live to 150 years old has already been born.
Yeah.
No way.
Now, I mean, how would you plan for retirement for somebody that's expected to live that long?
Sure.
That might be an extreme example, but the reality remains that longevity is going to become something that is something that investors are going to have to grapple with in their retirement. How do you plan to live to perhaps 120 years old? And the strain that causes on your retirement savings is massive. Obviously.
Precisely, because you've got 40 years of your working life, and if you're still going to survive for another 40 potentially after that, then sure, one wonders if you should be eating whilst you're working.
Yeah.
But Patricia, I'd like to come to you because another particular issue when it comes to retirement savings, especially in South Africa, has to be preservation. Often we find people tap into their savings for retirement and use it on whatever consumption needs or settling debt that they have. Is that a particular issue as well in the Kenyan environment?
Yeah, I think the environment here is very similar from both an individual, or family type of setup. We're not too different from what you're experiencing in South Africa. So our learnings from your market, I think, pay a lot. And I think one of the things we've learned is maybe try and not encourage too much consumerism over time and try and start inculcating that saving culture. As he says, if you're going to live another 150 years for me, it's a bit worrying to imagine who would be taking care of me at that point. So trying to save now makes sense early on in life.
I'd like us to address another fallacy, and Patricia, just to stay with you before we come to our studio audience, is alternative means of saving. People occasionally purchase property and rent it out and think that they might make a killing on their investment, but in reality things don't often work that way. How should we then be addressing this particular fallacy then in the market and educating consumers about the appropriate asset classes maybe to invest in to get a reasonable return that beats inflation, by the way?
Well, I like the last word you used, which is we need to be patient. I think investment is all about compound interest. I mean, a simple number, if you start with 100, you know, and you multiply it even at 10%, within 3 years you have an extra 33 shillings with you, or dollars. So for me, the patience around the investment and the fear or the need to quickly make money, which is what has happened to our economies now, or to our young people, is actually very worrying. Asset classes, if we look at our market today, you know, just starting with a basic money market fund, you know, it's probably earning 9 to 10%. But if you're keeping your money in the savings, you know, with a bank with less than 2% saving rate, 3%, then you're struggling. You're already losing value that could be working for you from the onset. Our market is pretty open. I think the regulator has ensured we have sufficient number of products. So, you know, you can go into a unit trust. So, for example, the old mutual unit trust with a 10 shilling mobile app investment. To buy shares in our market, you just need to buy 100 units of shares. We've had a great run. I mean, right now we are coming down on the stock market side. If you look at the indexes, I think we're now about, you know, we've come down significantly. Is that an opportunity to buy? But when you get in as an individual, you know, don't get in to make money in 6 months. Stock markets turn around. They will take a while to turn around. It takes 2 or 3 years. Look at the good story we have with Safaricom. It listed at 2 shillings. Our retail investors sold off at 2 shillings almost. And today this share is almost getting to, you know, highs of 15, 16 shillings.
Yeah.
From a return perspective, that is amazing. But we have this need for quick speculative cash, and everyone is just taking money into property. So you wonder how many people actually make good money out of this, or if it's one of those, you know, nice ideas that will crash and burn and hurt a few people in the long run.
On that note, let's get a quick recap of the key takeaways from tonight's discussion. Well, let's start with the two of you, gents in studio. Peter, following what Patricia has shared with us about not being in a hurry to make a quick buck, I take it that's one of the key maybe pillars that we need to pinpoint here in this discussion.
I absolutely agree. I think the key takeouts for me from our discussion are structuring your asset base properly for retirement, short, medium and long term, making sure that you do understand longevity risks. I mean, a lot of people are referring to retirement nowadays as what will my next job be. It's job replacement, not retirement. And I think the other key takeout is make sure that you have someone who has a very good understanding of the various investment value propositions to guide you through that environment to make sure that you make the right long-term decisions. Those would be my key takeouts. Stephen, yours?
Yeah, so look, mine would be pretty similar. I think one of the important aspects which we touched on was a risk perspective. So obviously it's often uncomfortable to take a little bit of additional risk, but sometimes very necessary to generate those real returns, so those after inflation returns. And then perhaps just to add a bit of an African flavor to it, is the currency side of things. So very often we look at these official CPI or inflation gauges, and we plan on that basis. But the truth is, for a lot of middle income and upper income customers, I mean, those numbers are largely fictitious. You know, a 4% inflation rate for a South African, on average, probably doesn't work, you know, your high net worth individuals, because they live on an imported lifestyle where the South African rand appreciation hurts them pretty badly. So it's an additional consideration to consider when making your retirement savings plans.
Making us think of other issues. Yeah. Huh? Patricia, just from your point of view, your key 3 points that viewers need to take away from tonight's conversation.
I think it's good to know, one, that I'm probably going to live to 150 years. That puts reality in perspective and makes compounding a real thing, you know, over the long term. I think the second one I've learned is our markets are not different. We need to learn from each other. And more importantly, when you look at East Africa or Africa, you know, don't get scared. We have the same demographics as, you know, most of the other markets, and we worry about the same things. So that for me is a good takeaway from people. If you could be patient, learn from each other, you know, don't assume there's a new thing happening in the market, and you'll make it.
Seems as though it all comes together only if you have a plan in place and exercise patience thereafter. Well, that's where we leave it for Personal Finance this evening. A big thank you to all of my guests. Peter Hewett, he's a certified financial planner and the 2014 FPI Financial Planner of the Year. Stephen Schultz of the Investment and Savings Center of Excellence at MMI Holdings and in our Nairobi Bureau. A big thank you to Patricia Kiwanuka, who is the MD of Asset Management at UAP Old Mutual Group. Remember that we want to hear from you, so tell us how you save and some of the pitfalls you've probably made in the past. Send your comments to @CNBC Africa using the hashtag Finance410 or to myself @Gukumfupi on Twitter. Until next time, take care everyone.